Hi everyone. If you're working globally, investing overseas, or even spending part of your year abroad, you have probably asked yourself this question: am I considered a resident in India or not? Now, here's the twist. The word resident doesn't mean the same under every law. The Income Tax Act 1961 and the Foreign Exchange Management Act 1999 both define residency differently. And that difference matters because your tax liability, your bank accounts, and even how you move your money abroad all depends on your residency status. While today's focus is on income tax residency, remember FEMA residency has to be checked separately and both need to be looked together for full compliance. Residency under Income Tax Act is purely about how many days you physically spend in India during a financial year. Here's the basic rule. If you are considered a resident if you stay in India for 182 days or more in a financial year, or you stay for at least 60 days in that year and 365 days or more in total during the last 4 years. Now, there are special relaxations for Indian citizens and persons of Indian origins. If you leave India for employment abroad or as a crew member of an Indian ship, the 60-day limit becomes 182 days. If you are an Indian citizen or a person of Indian origin visiting India, the 60 days become 182 days. So short visits don't make you a tax resident. However, if your Indian income excluding foreign income exceeds Rs 15 lakh, the 60 days threshold is reduced to 120 days. In other words, if you are residing abroad and earn more than 15 lakhs, from Indian sources, you will be treated as a resident in India if you stay in India for 120 days or more during the financial year. There is also something called deemed residency. If you are an Indian earning more than Rs 15 lakhs other than foreign income, and if you are not liable to tax in any other country, you are deemed to be a resident in India even if you haven't stayed here for long. Now, there are two categories of residents. Once you are a resident, there are two categories: resident and ordinarily resident. Your global income is taxable in India. And second, resident but not ordinarily resident. Your income linked only to India is taxable here. Simply put, if you are an ROR, India taxes your worldwide income. If you are an RNOR, India only taxes your income earned or received in India. Why it matters? Your residency status affects whether your foreign income is taxable in India, how you structure your salary, investments, assets abroad, what kind of bank accounts you can hold resident, NRO or NRE. So it's not just a technical definition, it directly impacts your financial planning and compliance. Now let's talk about residency under FEMA, which takes a different approach. While the Income Tax Act counts the days of stay, FEMA looks at your purpose and intention of stay. Under FEMA, you are a resident in India if you have come here to stay indefinitely, say to work, to do business, or to settle here. But if you have gone abroad for employment, business, or any other purpose that indicate an indefinite stay outside India, you become a non-resident under FEMA, even if you visit India often. So in short, Income Tax Act counts the days of stay and decides your tax residency. However, FEMA looks at the intention and purpose for deciding your regulatory residency. While FEMA residency rules are based more on the intention and purpose of stay rather than just the number of days spent in India, both Income Tax Act and FEMA residency should be assessed independently. Why this matters? You could be a resident under one law and a non-resident under other law, and that can completely change how you're taxed and how you manage your foreign assets. So next time you're planning to travel, career move, or investment, don't just count your days in India. Also keep in mind that residency under FEMA may differ, but both need to be considered to stay compliant. Thank you.